Today we're going to start talking about stocks and bonds, which, as you probably know, are like the core instruments in a personal financial strategy for most people. There's real estate investing, there's starting your own business. These things matter, but not everybody's going to be involved in those. But really everybody who's planning to retire is going to have stocks and almost certainly bonds as well. And so we need to understand how these things work. Obviously, there's so much we could talk about with stocks and bonds, right? The whole field of finance is devoted to thinking about things like stocks and bonds and related assets. But this is just personal finance, and the goal is to improve your personal finance skills. And so I'm just going to try to give you an introduction to stocks, explain how they work, and then ultimately we're going to figure out how to fit these into our strategy. All right, so let me define stocks. Maybe you know what it is, maybe you don't. Stocks are financial assets that represent ownership of a company. Literally, owning a stock means you are a partial owner of that company. So I own thousands of companies, and you will at some point in your life as well, because ultimately what people do is they end up buying a lot of different stocks. And so you end up owning tiny little bits of lots of different companies. And since companies usually are very good at making profits and they tend to improve their profits over time, stocks tend to become more valuable over time. In regards to stocks, a couple of things you should know, a couple of ideas. There are shares, and a share just represents one little chunk of the company. I'm going to use that term. Shares represents just tiny little pieces of the company. So if you're the shareholder of Google, that means you own a tiny little share of the company. A lot of times people get wrapped up into share price, and you might look at a company like Google. Their share price right now is really high, and you might compare that to a company like Ford. Their share price is pretty low, but those share prices don't necessarily show how valuable the company is, because a company can choose to break up their company into a lot of shares or relatively few shares. So what I mean by that is, if you're Facebook, you could decide you're going to issue 1 billion shares, and those shares will be worth not so much, or you could issue 1 million shares, and those shares would be worth a lot more, right? So if there's a company with a lot of shares, it just means they've divided their company up into more chunks. If there's a company with few shares, bigger chunks. So owning one share would be a greater share of the overall company. So there are shares, and each share has its own price. So a share price is just a price of owning one chunk of the company, if you will. In the past, to invest in a company, you had to buy at least one share. Some of that's changing actually over time, where you can buy different increments. You might buy 2.5 shares of a company. But generally speaking, to buy into stocks, you got to buy individual shares. So I was just looking at my portfolio. I have 143 shares of Ford, for example. And so the share price represents the price to own each individual little piece of the company. You may hear this term, again, related to shares. Shares outstanding, that's just the number of shares that currently exist. Sometimes companies will issue more shares. Sometimes they'll do something called a buyback, which means they buy some of their shares back from the shareholders. But shares outstanding represent the number of shares in a company. And this will lead us to just a real simple but nice idea. This idea of market cap. I believe market cap is like the market capitalization rate is the more formal term. But people almost always refer to this idea as just market cap. Market cap represents the value of a company. So whereas the share price would show how much it costs to buy one of those little slices of the company, the market cap shows the total dollar value of a company. And you can figure out the market cap of a company very easily. Think about it this way. If there are 10 shares issued of a small company, and each share is selling for $100, well, then that company is perceived to be worth about $1,000. So market cap can be solved by a little formula here. The price per share, all right, the price per share times the shares outstanding. All right, running out of room here, but there we go. So the market price is the price per share times the shares outstanding. If you just want to mess around, you can go online. You can find the market cap of a bunch of different companies, or you can solve for it yourself. I was just messing around, and I did this for Ford. Ford right now, just as an example, Ford has a share price of $7.55. Might be watching this video in the future. I wonder if it's going up or down. Right now it's 2020. We're coming out of the coronavirus scare. Share price is $7.55. The shares outstanding is about 3.91 billion. And so if you multiply this together, that gives you an estimate of what the company is worth, okay? And what you'll learn about stocks is stocks don't always tell you what the company is worth right now, but oftentimes they're indicative of what people expect the company to be worth. So if you think about a company, for example, like Uber, right now Uber is not profitable. Maybe you know this, maybe you don't, but Uber has been a very unprofitable company so far. But the thinking is that over time, the business they're in is going to become more and more profitable, thanks to things like self-driving cars, potentially drones, and other types of technology that can improve their profitability. So Uber is worth a lot of money in terms of market cap, but in terms of their revenues and profits right now, they're losing money. They're a negative profit company. And so stocks don't always tell you what the company really is worth right now based on what it's been earning, but rather it's a prediction of how that company will perform in the future. All right. So if we multiply those two together, we'll get market cap. And this comes out to about $29.5 billion. So Ford is estimated to be worth about $29.5 billion when you use stock price and stock shares to estimate their value. Okay. There are many ways you can invest in stocks. You can buy stocks. This is often referred to as going long, right? And this is typically what you're going to be doing. Frankly, in my opinion, a personal financial plan really can just be based on buying and eventually selling stocks. There's really no reason to get involved in some of these more complex issues. Because you may have heard of people, for example, shorting stocks. You can short sell stocks. All right? So this would be taking the short position. When you buy stocks, you're hoping the stock goes up in value, and that's ultimately the position you're in, right? Right now I own Ford stock. I hope their stock gains value over time, then I can sell it and lock in a profit. There's a way to reverse that transaction. Instead of buying stocks, there's something you can do called a short sell. I'm not going to get into the specifics of how this works, but essentially you're betting that the stock will go down, okay? And there are definitely people out there who use short selling to reduce risk, potentially to make profits. But the bottom line is for people like me and you, there's really no reason to care about short selling at all. I have a pretty good personal finance plan. I've never shorted stocks. I think maybe I did one time just to do it, just to say I had done it. But really, there's no reason to do it, all right? Because stocks tend to go up over time. Stocks tend to gain value over time. So if you're short selling, you're taking a risk against what the market normally does, right? If the market is normally going up, it's usually not a good idea to make a bet that it'll go down, all right? So you can buy stocks, you can short sell stocks, and then there's all kinds of advanced techniques you can use beyond this. You know, you may have heard of trading options, making margin calls. There's all kind of stuff you can do. We're not going to talk about that. In fact, number 2 and number 3, we probably won't talk about these at all in this class. If you want to talk more about these, take some other finance courses, not personal finance. I think we have an investments course offered here at Georgia College. Take that. But for most people's personal finance strategy, they don't really care about that. It's not necessary to know. All right, so let's think about why you want to own stock. Lots of different assets out there. Why would I want to own stock? Why not just leave my money in a savings account or something? Short answer is this. Businesses become more profitable over time. And I don't know about you, but I would like to have a piece of those profits. Okay? Businesses become more profitable over time. Now, there are obviously businesses that fail. You know, you can think of many examples of businesses that were once very profitable and now they're not profitable, or perhaps they've gone away entirely. Well, in those cases, owning shares of that individual company is not a good idea. But the problem is it's really hard to identify which companies are going to do well and which ones are going to do poorly. But what we do know is society tends to get wealthier over time. Technology improves. Capital accumulates. Things like buildings can be used many times. So once you make a building one time, you can use it many times into the future. So over time, we tend to get more stuff, right? We tend to have more buildings, more computers, more bulldozers, more of everything. And since we have more stuff, and since technology is improving over time, wealth tends to go up. And so what you want to do is you want to be tied to that wealth, and there's no other good way to do that. Putting your money into a savings account does not connect you to these businesses, okay? Putting your money in a savings account does not make you receive profits, not at all. Savings accounts are just an agreement between you and the bank. And the interest rates are usually pretty low, and usually there's no risk. In stocks, they tend to be pretty risky, but the returns are so great, you pretty much have to be willing to accept some of that risk. In regards to stocks historically have provided about 10% interest. Per year to shareholders. So if you could kind of go back to 1950 and just randomly invest in a bunch of U.S. stocks, on average, you would receive about a 10% annual return. And that doesn't involve inflation. Inflation is usually about 3%, so it's about a 7% real return. We'll talk more about that in a later class. But a 10% interest rate, that's obviously a lot higher than what you're going to get from like your savings account. I bet your savings account right now is getting less than 1%, right? So if you need to retire in the future, you're probably going to have to own stocks. It's very hard to retire without stocks because the growth rate is just so much higher for stocks than it is for really any other tradable asset. Okay, so about a 10% interest per year. This is broken down into 2 groups. There's 2 ways stocks pay out. All right, we'll start with what you probably know. What's most obvious? The share price tends to increase over time. All right, as companies become more profitable, the value of each individual share tends to go up. All right. In other words, owning Apple right now means more than owning Apple meant 20 years ago because Apple is more profitable. And so as a company gets more profitable, people are willing to pay more to own the stock. So share price can go up. The other way that stocks provide value is through dividends. Dividends are something most companies offer, most publicly traded companies offer. Dividends are just profits given to the shareholder. So I mentioned that I have Ford stock. As a Ford stockholder, I will consistently receive dividends from the company. I don't know exactly what the rate is. It's probably something like 2% for Ford. So what that means is if I own $100 worth of Ford stock, I'm just going to be given $2 in my account every year, right? Oftentimes it's like on a quarterly basis. So 4 times a year, I might get 50 cents. So different companies have different ways of distributing these dividends. Some companies, like Uber, that aren't profitable or trying to grow, decide not to offer dividends. Basically, they need to reinvest the money that they have right now. Companies that are more established tend to offer these dividends, all right? So as an owner of stock, there's kind of 2 ways to think about this. In regards to retirement planning, I don't so much care where the money's coming from. If the share price is going up or I'm getting dividends, either way, that's good for me. But the problem is they're taxed differently, and you have to think about what sort of dividends you're going to receive and what you're going to do with them, right? In regards to dividends, with my Ford stock, when they pay me dividends, the money doesn't like buy more Ford stock. The money just shows up in my account. I've got an account through TD Ameritrade, which is a website you can use to go and buy financial assets. And so I'll just look in there and it'll say, oh, your account now has $3 in it. So I've got to figure out what to do with that money, okay? And we'll learn that these things are taxed differently. So it's something we definitely need to think about. On average, stock prices tend to go up about 7% per year, and dividends have been responsible historically for about 3% of that growth. All right. So basically, this 10% here can be divided 7% based on stock prices going up, and 3% based on dividends going up. All right. Dividends paying out every single year. All right. So what this might suggest is, on average, if I buy $100 worth of stock, I might expect to receive $3 in dividends this year. And I might expect that my $100 in stock would be worth $107 next year. All right. There's 2 ways that stocks provide value. All right. So that 10% return is really high, and a lot higher than you can get from just about any other financial asset. And we know that stocks are risky, but they're not crazy risky. Okay. So basically, stocks are risky, but they tend to increase, they tend to provide value over time. And we'll talk about where that risk comes from and how to deal with it here in just a bit. So basically, if I'm thinking about why I want to own stocks, here's my answer. I want the 10%. And of course, the negative always of stock ownership is that it's risky. But I would just point out that the risks aren't as bad as they seem in regards to stock. They are risky, all right? But if you're willing to hold stocks for a long period of time, that risk isn't so bad. Now let's talk a bit about how we can manage risk. Stocks, we know, give us really big return, historically about a 10% annual return, but they're also very risky. And so we need to figure out how to deal with that risk. So let me give you an analogy here. This is a game where I'm going to flip a coin, okay? And this is gambling. Let's face it, putting money in the stock market is kind of like gambling. It really just is gambling. So let's say that I give you this opportunity. I'm going to flip this coin. It's a completely fair game. 50% heads, 50% tails. If it's heads, you win $1,000. And if it's heads, you win $1,000. If it's tails, you lose $900. So think for a second, would you be willing to play this game? All right, so I offer you to play this game, and I say, okay, we're going to play this game once. Do you want to play it? All right, you probably give me an answer. Some of you would say yes, some would say no. Your answer to this would kind of, suggest how risk tolerant you are. It might suggest how badly you need money right now, et cetera, et cetera. What if I offered you the same game now and said, you can play it 1,000,000 times if you want. You can play it 0 times, or you can play it 1,000,000 times. What's interesting about this game is playing it 1,000,000 times seems way better than playing it once, right? Obviously, this game, on average, 50% of the time you're going to win and 50% of the time you're going to lose. But if you can play this game a bunch of times, on average, you'll win money, right? Because when you win more than you lose when you lose, okay? So I'm guessing some of you would not want to play this game 1 time, but I hope that all of you would agree to play this game 1,000,000 times. Because if you play it 1,000,000 times, chances are you're going to end up extremely wealthy. If I offered you to play it 1,000,000,000,000 times, it's even better, right? not only does playing this game more times mean you're going to, on average, win, but as you play more and more times, it's becoming increasingly unlikely that you'll lose money, right? This is, referring to something called the law of large numbers. This game is in your favor if you play it once, right? It's in your favor if you play it once. But it becomes more and more of a sure thing the more times you play this game. All right, and we can mathematically prove this, but if we play one time, 50% chance you'll lose. If we play a trillion times, it's basically a 0% chance that you're going to lose money because this game is in your favor. So the more times you can do it, the more likely you are to win. This same sort of concept is why casinos are profitable, right? Any individual game of blackjack, one hand of blackjack, the casino has a small edge, but it's basically a 50-50 chance. But if a casino can get many players playing thousands and thousands of hands of blackjack, the casinos will win in the long run, okay? So in this case, you want to be like the casino. You want to be on the side of the person who wins more when they win and loses less when they lose. And that's ultimately what stock ownership is like. You would like to play the game as many times as you could, okay? So to extrapolate from this analogy, if I give you the opportunity to hold stocks for one day, are you gonna make money or you're gonna lose money? It's basically a crapshoot, right? About a 50% chance you'll make money, about a 50% chance you'll lose money. If you hold it for 100 days, it's not really all that much different. Your chances are it will go up, but it's only about a 55% chance. What about if you hold it for 3 years? Now you're approaching a range where stocks are very likely to go up. It's very uncommon for stocks to receive a negative growth rate over a 3-year period. Okay. Now, when I say stocks here, I'm kind of jumping ahead of myself. Individual companies often lose money or lose stock value over a 3-year period. But if you collectively think about all stocks combined, it's very infrequent, not impossible, but very unlikely that stocks will lose money over a 3-year period. All right. And it's really the same concept. Stocks on average tend to go up. So you want to hold them as long as you possibly can. Holding them for one day is kind of like playing this game one time. Very risky. Who knows if you'll win, right? 50-50 chance. Playing it 100 days is kind of like playing this game 100 times. It's probably going to go up, but it's not super certain. 3 years now is like playing this game like 1,000 times, right? Playing it 1,000 times, you can be pretty sure you're going to win. So you want to hold stock as long as you possibly can. Furthermore, you would ideally like to end up in a situation like this. Imagine there's another game you can play that offers this possibility. All right, so if it's heads, in this case you lose $900. Call this game 2. All right, so looking at these two games here, if I said you can play either game 1 or game 2, which one would you want to play? And you should recognize there's no difference, right? Playing game 1 or game 2 has exactly the same advantage to the player. But now what if I told you can play both of these games at the same time? Now this is looking pretty good, right? If I allow you to play both of these games at the same time, you could basically just choose to play both. And if it's heads, you would win 1,000 here, lose 900 here for a $100 profit. And if it's tails, you would win 1,000 here, lose 900 here for a $100 profit as well. So you've basically eliminated the entirety of risk from this. You're guaranteed to win $100. Stocks don't really give you the opportunity to do this, but the analogy here is to think about what stocks you want to own. All right? Do you want to just own Apple? All right? Maybe Apple is a representative of game 2. Do you want to just own Apple? Well, what if Google ends up developing phones that are better than Apple's, right? What if Google starts creating computers and they basically win out over the market over Apple? Well, in that case, you certainly would wish that you had some Google stock as well. And so when it comes to stock, there's 2 things you want to do. One, you want to own a bunch of different companies, not just Google and Apple, but all of them, as many companies as you possibly could. Because some companies will win out, some companies will lose. If you hold all of them, right, you're basically holding the entire market. The market on average goes up. So you're going to sort of bet on every possible outcome. When it comes to coins, it's just head or tails. But when it comes to society, right, there's millions of different possibilities of what could happen in the future. So just hold all of the companies. Have little chunks of all of them, right? You not only want to hold as many companies as possible, but you also want to play the game as many times as possible. So ideally, if I'm looking at these two games, what I would say is I want to play game 1 and game 2 as many times as you'll let me. Just like that, I'd like to own as many stocks as I possibly could for as many years as possible, all right? So thinking about what that means collectively. So let's summarize what we know so far. We're not done with stocks. Something we're going to talk about, over and over in this class, but we're improving our skills. What we know so far is stocks average 10% annual returns, which is very good. Better than really any other asset that isn't crazy risky. So stocks are kind of in that sweet spot where they are risky and they give you return, but they're not crazy risky. All right. So stocks are risky, but they tend to go up over long periods of time. What I mean by that is, like we just showed, what the stock market might do over a 3-day period is basically a coin flip, but what stocks are going to do over a 30-year period looks like they pretty much always go up. Okay, you never can say 100% of the time they're going to go up over a 30-year period, but they have every single time in the U.S. In fact, in the U.S., I don't think there's ever been a 10-year period where stocks haven't gone up. So if you take any given date in U.S. history where the stock market was a thing and you bought stocks, held it for 10 years, you'd make a profit every single time. I believe that's the case. So if you can hold them for a long period of time, they generally do go up in value over time. All right. So what this means is you want to buy stocks when you're young. And this is part of the reason why I feel so compelled to teach this class is because it's you that has the greatest chance of improving your retirement situation. I hold these retirement seminars for Georgia College faculty. And, I'll say, we're going to do retirement planning. I'm going to explain to you how to invest, what sort of assets you're going to hold, how to avoid taxes, a lot of the same kind of stuff that we do in this class. And I invite all faculty and staff members. And who do you think comes? It's like 60-year-olds, right? 60-year-olds come to it because they're like, oh, I need to retire and I haven't saved enough money. The problem is when you're 60, it's really hard to improve your wealth. Because if you're 60, you can think of it this way. You don't have a lot of coin flips left, right? If you're going to retire at age 65 and you're 60, buying stocks is going to seem pretty risky. Over a 5-year period, it's feasible that stocks could go down in value. But when you're young, it's very, very likely that they're going to go up. So right now, if you're watching this video, maybe you're 20 years old, maybe you're 40 years away from retirement. Over a 40-year period, stocks are virtually guaranteed to go up in value. And let's think about what those returns look like. Let's say if you could put $100 in the stock market right now, $100 in the stock market, and let's just think about annually compounding that, all right? If we put $100 in the stock market at 10% growth for 40 years, let's see what that would be worth. I'm going to do this math really quickly. And boom. There you go. $4,525.93. So $100 saved right now in 40 years would grow to about $4,000 if we see the same returns we've seen in the past, which is no guarantee, right? But we might say we're pretty sure it'll be between $1,000 and $10,000. over a 3-year period, not only is this value going to be much smaller, right? If I change this to a 3-year period, you're going to get a much smaller value. But also the risk is much greater. Over a 40-year period, you can weather the highs and the lows, right? Over 40 years, there will be recessions, there will be expansions, there will be probably wars, there will be things that affect the economy. There will be, coronaviruses and such. But over a 40-year period, you don't so much care, right? If you're investing for a 40-year period, you don't really so much care what the stock market does tomorrow. You just care what it does over a 40-year period. To put this another way, do you wish you could have invested $100 40 years ago? Hell yes, you do, right? Over long periods of time, stocks tend to go up, and you want to invest as early as you possibly can to not only get big returns, but also invest when you can handle the risk, okay? Remember that these companies are just trying to make profits, and they're getting better at making profits every single day. So if you believe the U.S. economy is going to get stronger over time, like it has over the past several, basically since it was born, then you want to hold stocks, because stocks will do well as long as we get better at producing things. And we do, right? So stocks, average 10% annual returns. They are risky, but they tend to go up over long periods of time. Managing risk. There's 2 things we want to do. A, hold for a long period of time. Many years, right? Invest for as many years as possible. Stocks do this over the short run, but over the long run, they tend to go up. So you want to hold for as many years as you possibly can. And secondly, you want to own many different companies. You don't want to just invest in one company, because individual companies are very risky. That's kind of like just putting all your money on one hand in blackjack. Not a good idea, even if you're the casino, even if you have that little bit of an advantage, right? You want to diversify. So you want to diversify in 2 ways. You want to diversify in terms of the companies you have, and you want to diversify in terms of the days that you're owning the stocks. A lot of times people talk about the second one here, which is owning different stocks. But think about it this way. Some days are good, some days are bad. More are good than bad. So you want to diversify by having as many days as possible, which just means you want to hold stocks for as many years as you possibly can, which means investing young, all right? So that's stocks. Next, we're going to think about bonds, and then we're going to consider the tax ramifications of holding stocks and bonds.